Hello, and welcome to today's NIC Leadership Huddle. Today's session is called Prominent Real Estate Research Directors Discussing Market Trends in the Economic Outlook. This is the second Leadership Huddle of our 2022 webinar series. My name is Beth Mace. I'm the Chief Economist, Director of the Research and Analytics team here at NIC, and I'm going to be your moderator for today's discussion. We welcome your questions during this discussion, and if you'd like to ask a question, please submit your question in the Ask Questions pane, which is located within the middle and towards the bottom of your On24 window. We'll address submitted questions throughout and near the end of the Leadership Huddle as well. Now, moving to our panel discussion today, it's my total pleasure and delight to introduce today's panelists. Mike Acton, who is Managing Director and Head of AEW Research at AEW Capital Management, and Mary Ludkin, Managing Director and Head of Global Investment Research at Heitman. I've known and worked with Mike for more than 25 years, both at DRI McGraw-Hill and then at AEW Capital Management. And I've known Mary for nearly the same number of years through NCREIF and other affiliations. I'm thrilled that they're both here to join us today. So with that, Mary, you want to introduce yourself a little bit to the audience?
Sure. Thank you so much, Beth, and it's great to be back with you and Michael. Heitman, my firm, is a real estate investment advisor based in Chicago, which is where I'm speaking from right now. We have $51 billion in assets under management. We invest in North America, in the UK and continental Europe, and across Asia Pacific. We invest across a couple of different stripes of real estate. We make debt investments. We buy private equity real estate outright for separate accounts and in fund form. And we have a REIT group that manages portfolios of real estate investment trusts and other publicly listed stocks. We are investors in the four main property types within real estate, and then within a bunch of alternatives that include seniors housing, student housing, medical office, self-storage, and single-family rentals.
Great, thanks, Mary. Thanks for being here. Mike, how about yourself? Can you introduce yourself a little bit more in AEW?
Sure, of course. Thank you. And also glad to be with you and Mary today. My favorite introduction is the way Churchill used to introduce his nemesis, Adley, a humble man with much to be humble for. I'm the head of research for the AEW in the U.S. Been with AEW a really long time, since 1990. The description of AEW is almost a mirror copy of what Mary said is the description of Heitman, global institutional investment manager operating here in the U.S., Europe, Asia Pac, both in debt and in equity, on the equity side, both in public and in private. And much like Mary said, we also invest primarily in the four major property sectors, but have been an investor in seniors housing since the mid-90s, very active in things like cold storage, medical office, other aspects of healthcare as well.
Great, thanks, Mike, for being here. So, may you live in interesting times is an expression that some claim to be a translation of a traditional Chinese curse. While seemingly a blessing, the expression is often used a bit ironically. Life is better actually in uninteresting times when certainty and peace exist, rather than in interesting times when unprecedented times and uncertainty exists and there's a lot of risk. While we certainly do today live in very interesting times with unprecedented events such as a pandemic that's still underway, the Russian invasion of Ukraine, the strongest inflation in 40 years, full employment with a jobless rate of 3.6%, a bear market for the stocks, a significant shift in monetary policy as the Fed responds to inflation by pushing interest rates higher. So, Mike, starting with you, with these very interesting days, how are you advising your teams and clients regarding the economy and inflation?
Well, first and foremost, what I've been doing with both internal and external audiences is really just trying to pull things back and give people a sense of perspective. There's a lot of craziness going on in the world today. It's very compressed. I think an awful lot of people have very clogged bandwidth. There's a lot of you might call it crisis fatigue going on. It's just sort of one thing after the other. And what I've come to discover, just really come really into focus the last few months, is unless you're over a certain age, which all of us on this call are, unless you're over a certain age, you don't really remember inflation. You don't remember Fed tightening cycles. You don't remember the Soviet Union and the Cold War. I was giving a talk internally. I had sort of worked in a thing from the old Beatles song back in the USSR, and I was talking to some young people in our company, and they sort of looked at me and they said, "Well, we kind of know who the Beatles are, but we don't know that song." And I'm like, "You got to be kidding me, right?" Like, so it suddenly occurred to me that for the most part, if you don't remember where you were when you learned that the Berlin Wall had fallen, you don't remember much about Cold War and Soviet Union and such and all those kind of things. And honestly, there's quite a few people, both internally and externally, clients who've never been through a Fed tightening cycle, and they just don't even know what that means. It all seems very scary and mysterious to them. So I've been mostly trying to get people to sort of take a deep breath, understand that cycles happen. We've gone through a lot of cycles. They're all different. But like Mark Twain said, history doesn't repeat, but it certainly rhymes. And there's commonality in cycles in things that do represent themselves. So I've really just been trying to educate people on what aspects of what we're going through are similar to prior cycles that we've experienced and what's different. And there's a playbook. We sort of know what we're supposed to do as these events unfold. They're just unfolding very, very quickly. I mean, the increase in interest rates that's happened in the last 6 weeks, in percentage terms, it's the fastest increase in interest rates ever. And that's very jarring to a lot of people. So I'd say that's the main thing I've been doing the last few months.
And Mary, how about you? Same question. How are you advising your teams and your clients regarding the economy and inflation?
Oh, I love the way Michael put it, in that there is a playbook. There wasn't a playbook back when I didn't realize Michael and I started in professional real estate in 1990, institutional real estate, same year. There wasn't a playbook. We watched a recession unfold a little bit after we arrived. I got my window office over the bodies of the fallen masters of the universe that washed out during that ugly, it was just a 3-quarter recession, but it was 4 years in California, and lots of portfolios were weighted with California because it was never supposed to turn down there somehow magically. What's changed that we suggest to our investors has made it possible to invest across the cycle. So no need to sit on the sidelines. Now that sounds a little self-serving, but their job is to get their capital to work in a smart way. And in this environment, if you're antsy and worried about the stagflation, that's our best outlook, and recession is the worst case, but a realistic case, in that environment, you can invest through debt as opposed to taking equity risks. So somebody's there in the first loss position ahead of you if you're really scared about changes in economic drivers for real estate. My colleague who's based in London used a term that I will share with you. You can also look at the GDP independent sectors. When Michael and I started, when Beth and I started, we basically invested in 4 property types: office, industrial, retail, and apartments. Well, today you can go long in sectors like senior housing, where there's a demographic driver as opposed to a GDP or a job growth driver behind them. There are nuances to that need to be recollected, including the fact that many people, as you well know on this call, many people can't move into senior housing without selling their home, and there are moments when the for sale market is gunked up. That's not exactly the case today because there's so many people eager to invest in a single family home that will put up with the higher interest rates because they want to have their moment. So we are suggesting to them that there are levers you can pull and should pull to put together a portfolio that should ride you well through it. And finally, I use a tired but apt analogy, which is in an environment like this with inflation at levels we haven't seen before, and our data for when we did see it, which dates to the early 90s, isn't very good. Institutional real estate sometimes wasn't being appraised with any frequency. So I'm not sure I really believe the return numbers, particularly from the early 80s. But what I can say comfortably is real estate's in better position than stocks and bonds. We're calling it the cleanest dirty shirt, which is not original. I don't have an attribution for it, but it's a pretty good metaphor for this environment where We know that real estate isn't a perfect inflation hedge, but it's a pretty good inflation hedge and way better than stocks and bonds.
Yeah, so we know that for the bond market, this is like the worst return year since I think 1976, and certainly the stock market hasn't started out particularly well this year. So real estate looks pretty favorable against that. So within real estate, is there any particular sector, Mary, that you favor more than others? I think you mentioned investing long, so that might be something like a demographic play like senior housing or maybe even multifamily.
Yes, absolutely. There's a lot of nuance that needs to get applied because there are places where there's significant amounts of supply underway. So keep an eye on that in investing, because we know real estate works best as an inflation hedge when supply and demand are basically in alignment. Especially for short lease term sectors, or real estate is an especially effective inflation hedge in sectors where you're not having to worry that your lease will be honored with its annual rent steps, and your rent steps are likely way lower than the 8% current inflation level. We were really excited in medical office. We have some portfolios where we have 2.5% annual increases or 3%. That looked really good until 6 months ago. One thing I would also note is when we started in the business, there were clauses in long-term leases that meant that rent reviews were linked to CPI. Those went away when CPI was too low to keep up with annual growth and whatever. And so they went and they got converted to fixed bumps. Now we could likely see leases being structured with CPI clauses in the future. But in an environment like
we actually see that right now with Social Security increases, because they still have a COLA. So
yes,
that's pegged off of the CPI in October, November timeframe. So this past year in January, there was a 5.9% increase in the COLA for Social Security recipients. So they are actually one of the protected, in a sense, protected because they're seeing an inflation adjustment. Although 5.9% was, we thought at the time, I mean, like, oh my God. But now, it doesn't even look like it hasn't kept up with the overall CPI.
It hasn't. But the seniors housing, which is the focus for many of the people that are dialing in today, it should, especially in places where supply and demand come back into balance, it should prove to be an effective inflation hedge.
Right. Okay. Mike, what about you? What are you thinking about when you look at inflation hedge real estate opportunities, or is real estate the place to be for inflation hedge? Is there any way to protect yourself against inflation?
Well, yeah, I think real assets in general are the place to be when there's elevated inflation. I happened to listen to Ray Dalio on a call driving into work yesterday morning, and they asking him, what do you think of equities? Oh, equities are terrible. What do you think of debt? That's terrible. Well, where should you put your money? He's like, oh, real assets. It has proven to protect you, and it largely protects you, I think, through replacement cost. If inflation's outsized for a period of time, your replacement costs go up. Somebody who's building the new building has to achieve a higher rent to get the same return on cost that you have at your basis. So if they raise their rent, you get to raise your rent, and it all works better if markets are tight. Like Mary said, if vacancies are low, the ability to pass on those rent increases is just that much greater. So it all works. There's a reason why institutions, were directed by ERISA to invest in other asset classes to diversify and protect themselves from inflation, and why they gravitated to real estate. I think having decades now of no inflation or falling inflation, disinflation, people got complacent, and that muscle memory to buy inflation hedges before you need them sort of got lazy. This will bring us back into focus for some period of time. Policymakers are almost always fighting, the last war rather than the next war. So I think the inflation hedging characteristic of property will linger around for quite a while after all of this resolves itself.
Okay, so let's shift a little bit to interest rates. And because of inflation, we see that the Fed has shifted dramatically its monetary policy stance from accommodative to restrictive. It's increased the Fed funds rate 75 basis points to date. Some are projecting it will be 2.5 to 3, certainly by next year. So how does that fit into your view of capital markets and so overall economic growth?
Yeah, I mean, real estate, as any asset class, real estate has to be competitive with other asset classes on a risk-adjusted basis relative to total return and relative to yield. I think the total return story is very compelling and will be. On the yield basis, though, as of Q1, the average cap rate, the average current yield, appraisal-based yield in NCREIF was 3.75. 10 years floating around 2.75 to up as high as 3. That's a pretty narrow spread relative to history. If you look at the last 20 years, the average spread between NCREIF cap rates and the Treasury is about 250 basis points. So obviously we're well inside of that. I think Beth, you know, I've always modeled cap rates off of corporate bond yields.
Right.
BAA yields over 5% today. Lower quality spreads have really blown out. So property is going to have to present a higher yield to investors, certainly yield-oriented investors, reasonably soon. And, you know, you can get to higher yield either kind of a pleasant way or an unpleasant way. The unpleasant way is valuations go down. The pleasant way is that your income grows relative faster than your values do. So I think there are property sectors, you know, Mary mentioned a few of them. I think generally speaking, I think most things related to residential, most things related to distribution and logistics, at least in the near term, are going to have NOI growth that's probably enough to hold values constant or maybe move them forward a little bit. Certainly some of the non-primary sectors, that's the case as well. There's other property sectors where it's just a lot less certain. Retail net operating income has recovered a bit. Got a ways to go to get back to pre-pandemic levels. Really, the greatest uncertainty today and the most difficult to underwrite would really be in the office sector. Who's going back to work? You know, how often? How are space needs going to change? And it goes far beyond just the overall vacancy or occupancy rate. It's really what's the utilization rate within that occupancy rate. You know, that data that everyone sees that Castle publishes now on the daytime occupancies. You know, we're nationally it's 45% of pre-pandemic levels. Some markets are as high as maybe 60. Some markets are lagging maybe 35 to 40%. If 60 is the new normal, and you know, if people go to work 3 days out of 5, that's 60%. Right. If 60 is the new normal, there's going to have to be a lot of rationalization of space going on. It's happened before. Again, none of this is without precedent. It's happened before in different markets. It's just happening pretty much everywhere at the same time for the office sector right now.
Great. And Mary, how about you? What's top of mind when you think about sort of the shift that we're seeing in monetary policy and higher interest rates and capital markets?
Well, first, I used to be able to say, let's call this 8 months ago, maybe 6 months ago, that while we were on a webinar, industrial cap rates compressed. Like in the space, it seemed as though they were going down every hour.
During the very hour, yes.
During the hour.
Within the very hour, right? And I think the opposite, there's upward pressure in lots of property types right now for the lesser quality assets, the lesser quality locations within markets, or the lesser quality markets to complete that trilogy. And so that's something that's occurring as investors who put 50% leverage or 65% leverage on something are looking at a period of 5 years in maybe a 5-year hold or a 10-year hold where the debt costs exceed their income. And they're not willing to do that. And so they're coming back for price hikes, price increases, price cuts. In some instances, we've been the beneficiary of that. In instances where somebody was underwriting a deal, took it down using a planned higher level of debt than we were. They fell out when they couldn't get the debt that made their numbers work, and things came to us. So it's still possible to buy in this environment. And the extent to which yields rise will be in part driven by the extent to which capital flows remain strong. Michael mentioned retail. That's an interesting sector where right now, because it's out of favor, initial yields generally still exceed the new level of debt. And that could bring some capital flows away from other sectors that are looking a little more iffy, especially sectors like logistics or industrial, where some of the big players appear to be on pause or about to put some space back into the market. That's not to say that this sector where vacancy rates are less than 2% in key markets like Southern California and Northern New Jersey, not to say there's a bloodbath ahead, but you're going to see investors trying to stack their portfolios to win. And that could include putting into them property types that they didn't need to pay attention to when they loved the growth prospects and the debt, the levered yields for other property types. So we're suggesting it's time to look a little broadly, look for places where the risk has been mispriced, and that includes retail. We also know that there has never been a direct link between cap rates and either the BAA corporate bond or 10-year treasuries. Michael, no doubt, has a plot that looks at the relationship since 1978 and the various data periods. There is no relationship. We know that. But we are observing that there's upward pressure even in the darling property types like logistics.
Very good. Okay, so let's talk a little bit about the sort of risk-reward profile for commercial real estate relative to the other investment types. So, Mike, you talked a little bit about, relative to bonds and relative to stocks. So what do you think the investment returns look like for broad commercial real estate in this year, and how does that compare to last year? And which property type, again, would you advise people to invest in? Starting, I guess, with you, Mike. Yeah.
Yeah, so we're coming off of just absolutely spectacular performance. The capital depreciation last year for NCREIF was around 20%.
Can you just say that again? I don't know that my audience would really know that. So just say, and then industrial was like 40, right? So just go through that one more time.
Industrial was almost 50% in the first quarter. The trailing 4-quarter capital appreciation was almost 50%. So think about that. The average warehouse in the United States went up 50% in value, give or take, in the last 4 quarters.
It's dumbfounding. I remember going back and looking at the data like 3 times and going, really?
It's that's twice as much as any 4-quarter movement of any property sector since the index began in 1978. So it's just really spectacular performance. Obviously that's not sustainable. It's not repeatable. The first quarter PRIA survey of people like me and Mary had a 5-year total return for NCREIF unlevered north of 7%. I imagine as the second quarter numbers are going to start getting collected by PRIA this week, I would imagine that's coming down because interest rates went up 100 basis points in a very, very short period of time. That all of that has to weigh. But I think real estate will stay remarkably competitive with stocks and bonds. It's a hybrid of the two things to start with, but the cash flow characteristics, the income characteristics, at least in the near term, are very visible, very underwritable in most cases. So I imagine property will be very competitive relative to other asset classes. Picking an absolute number for it, I don't know if that's such a useful exercise. But there's a reason why capital is allocating to real estate. That capital pressure that Mary mentioned earlier, that is real. I would caution, we've seen this in other cycles, that capital pressure can lessen much more quickly than we sometimes think it can. Anecdotally, I already know a few sort of very core U.S. investors that are pulling back for denominator reasons, not reversing, not pulling out, not liquidating, anything like that, but slowing down pacing. And it's interesting because it's happening at a time, because of what Mary was talking about with leverage becoming less accretive, it's happening at a time where the low leverage or no leverage investor really should have a moment of much less competition for assets that they'd like to acquire. It's been a very, very competitive market, obviously, for quite a while now, but certainly the last couple of years, it's been a very competitive market. Leveraged buyers have been able to take deals away from unleveraged buyers because debt's been so cheap. So it's an interesting time when it really should be a case where a lower leverage or unleveraged buyer should sort of shine right now. And hopefully it's not the case that they all have to slow down because of denominator issues.
So that's, we talk a lot about capital sitting on the sidelines. So when you're talking about this, your reference is that there'll be less capital on the sidelines, which would put less pressure from a demand point of view, which could have an impact on overall yields and cap rates then.
Yeah, I mean,
right?
the one big caveat right now, of course, is anytime there's global crisis like wars, money wants to be in U.S. dollar denominated assets and it wants to be in real assets in dollars. So that's sort of the countervailing part of all of that. But the allocations, almost all of our investors are below target. Their targets are all going up. As of the end of last year, most of them had dramatically expanded denominators, total assets. So the sheer quantum of dollars that was going to come to real estate was quite large as of December 31st. It's still quite large. It's just less than it was 3 or 4 months ago.
Okay. And Mary, what are you thinking about total returns for investors in commercial real estate for 2022 compared to last year?
They're definitely coming down. That's for sure. That said, I'm sorry, I've got distracted by a squirrel outside with no tail. One of the risks of working from home is distraction. I remember when core real estate delivered the kind of returns, well, something similar to the kind of returns that it did last year. The last time that happened, it distorted investors' views of what core real estate was all about, and then they were disappointed later on. So I hope that isn't the outcome. I do think that there are an array of reasons why returns will come down, including that upward pressure on cap rate that I mentioned. We've got sectors like office that haven't really been repriced. The best office is doing really well in terms of rate and in terms of on paper occupancy. But the B and the C assets, which are part of institutional portfolios, to a degree they would really prefer they weren't, those haven't really been repriced. So there's going to be some sort of repricing in that sector, more than has happened thus far. Rates are not as accretive as mentioned earlier. And depending upon what the economy does, we're going to have less growth in certain sectors, less NOI growth. So I do think that that's going to put pressure on returns as a whole. They're just not sustainable at the levels we saw last year.
Yeah, agreed. Okay. So let's switch now to focus on senior housing. That's what a lot of our audience is listening to today. So Mike, tell us a little bit about AEW's investment history and current activity in senior housing. Just for full disclosure here, I worked with Mike at AEW when AEW first started doing investing in seniors housing. So I was a research person on most of the deals that were initially done at AEW in seniors housing. So I think you're on your fourth fund, is that right?
Fourth fund, that's right.
Yep.
Yeah, the very first investments that AEW did in seniors housing were in our opportunistic fund series. It's about 95, 96. Just dipping the toe in, not really, it was all new to us then. What we liked then and I still like now is a couple of things. I mean, long term, obviously like the demographic story. I mean, it's very, very obvious, right? America's getting older and all that. That wasn't really the driver back in the mid 90s, of course, because the baby boom wasn't that close to retirement at that point in time. At that point, it was really sort of a supply and demand imbalance, I'd say. Always have liked the aspect of the property sector that it's a needed thing. Families need it, seniors need it. I think all of us on this call have had family members in seniors housing over the years. And it's a really important thing. I always joked with the young guys, I still do, with the younger analysts and so on here, that they'd say, "Oh, that's senior housing. That's so expensive." And it's like they always say, "Well, it's a lot less expensive than getting divorced when your mother-in-law comes to live with you, right?" So, I'm just joking, of course, but you get my point, right? So after that, we continue to do seniors housing in the opportunistic format, in the opportunistic series. But over the years, we've added separate accounts. We had big separate account relationships with big public plans for many, many years that were very successful. And then everything sort of changed around the time of the GFC. Some of those big public plan separate accounts had suffered big investment losses in other things. A lot of them had sort of prohibitions on doing anything that had the word housing in it because they had lost so much money in other parts of the housing market. So at that time, in conjunction with a lot of other clients asking for a fund offering, we started our seniors housing fund with the very first fund, and now we're, like you said, now we're on our fourth. We still like the long-term demographic story. We still like the need aspect of the property sector. Obviously, the whole pandemic period has been a tough operating environment, hard for people to move in. All the operational complexities of operating during a pandemic. But let's bear in mind, though, these properties know how to operate during times of outbreak it happens every season, right? They know what they're doing. They're very skilled at it. It's just a lot of other things going on. I think the property sector is poised for a good recovery. It's already happening on the occupancy side. It's going to take a little bit longer to happen on the repairing margin, I would say. These properties are higher operating leverage type properties, more labor costs, more of those services, those kind of things. So it's going to take a while to repair the margins, but I think we're on the way. And knock on wood, if we don't have some other big setback in terms of public health or something else, it should be a pretty good near-term recovery story.
So tell a little bit the audience about the relationships that AEW had with its operating partners and what had to happen during COVID. I mean, my observation was from both a debt point of view as well as an equity, that there was a dramatic support for each part of the pillar in terms of the partnerships in senior housing with equity.
Yeah, no, I think that's right. You could expand that. Yes, you're absolutely right that the lenders were totally willing to work. They understood that the things that were happening were outside of people's control. I don't think there's any situation where somebody was inferring, sort of bad intentions or bad actors. That isn't what this whole cycle's been about. It's very, very different. We could expand that to a much higher level. This whole cycle that we've just gone through, and it is a cycle, right? The National Bureau of Economic Research said it started in February of 2020 and ended in May of 2020, shortest and sharpest cycle ever. But it's very, very different than, say, like the GFC, where there was lots of finger pointing and blame around, who's responsible for the financial crisis? Is it Congress, or is it Wall Street, or is it, people falsifying mortgage applications? There was none of that in the pandemic. This was an exogenous, we could call it a black swan event, but with Mary Squirrel, maybe we'll call it a tailless squirrel event. Where nobody was to blame for it. So the attitude on the part of policymakers, on the part of lenders, on the part of partners was, let's figure out a way to help everybody and make everybody get through this intact. That's why collectively as a country we sent checks to just about every address in America all through the pandemic, and that didn't happen at all in the GFC. In the GFC, somebody was on TV every night talking about how we're becoming Greece and we can't do the bailout, we can't do TARP, we can't do the stimulus package, all that stuff. That is a very, very different environment. And at the more micro level of the properties themselves, I think everybody worked really well together. Our partners with us, with our lenders, to figure out how to get past this until the public health crisis aspect of it resolved itself. Because there was nothing fundamentally wrong with the properties or the tenants or the lenders or the documents or anything. It was truly an exogenous event.
So I was surprised that we didn't see a lot more distress assets in the market for senior housing, but as well as for other commercial real estate asset types. So where you still do opportunistic investing, do you see distress is coming down the pike in the coming year with higher interest rates and inability to cover debt service? And what's your view on distress?
Yeah, no, it's a really interesting question. There will be properties and operators that need to be recapitalized, I would think. Hasn't really presented itself yet. But remember, these things take a long time to sort of play out. After the GFC, not have nothing to do with seniors, but after the GFC, our opportunity fund that was operating at that time, about 80% of the properties they bought through buying the debt. But those properties didn't really start presenting themselves until 2010 and into 2011. It takes a long time for everybody to sort of go through that whole, if you remember back to high school, like when you read Elizabeth Kubler-Ross going through the stages of grief and despair and all that, I mean, it just takes a long time for that whole thing to play itself out. People stay in denial much longer than you think they would. So there'll be opportunities to recapitalize properties and operating partners. There'll be a culling, if you will, or a separation. There already is, of course, in terms of quality of operator and experience and all of that. But usually events like this, the strong get stronger and the weak sort of get weaker. And I imagine that'll be the case here as well.
Yeah, I mean, our data is showing, for example, in the first quarter that 30% of the properties that make up the properties within the largest metropolitan areas, or what we call the primary markets, have occupancies above 90%, but another 40% are below 80%. So there's definitely sort of, Mary, you were referencing this before as well, sort of the good operators and the good markets and the good locations with so forth. So Mary, Heitman invests in senior housing in Europe, I believe. Why Europe?
Well, I'll start, if you don't mind, with the Heitman senior story, which starts in the US about a decade after AEW. We were not early movers in the sector, but we got into it in a value strategy, and we're really pleased with the results. Although what you learn the minute you get invested in seniors housing is just how complicated it is to get that result. Getting the hospitality part right, getting the medical services part right, getting all of the elements right, especially in a time of sharply rising labor costs, for example, or in a pandemic where we learned how many people were working in senior housing that were working multiple jobs and the complexities that generated. In our instance, we were particularly favored when when we were working with an operator that wanted to go public, and that resulted in a really fine, wasn't a great operational experience. It was a great outcome on the sale when we sold to our partner. And that caused us to try to assess what was going on. And what we observed was that there was a great deal of supply being built ahead of the demand that my generation, the boomers, is going to create. We had obsolete housing stock, obsolete senior housing stock that needed to be replaced, but it was replaced in droves. So we'd find good markets and get swamped by too much supply. So that caused us to shift our strategy more to the debt side, lenders to senior housing developers or existing operators in the US. By contrast, we've gone to Europe, a setting that probably looks more like the US senior housing market did circa 1985, where there's clearly obsolete inventory that's being taken out of use because it doesn't meet code, it doesn't meet standards. So the inventory in certain locations is actually declining rather than rising quickly. And at the same time, components of the inventory that are deemed to be feasible don't fit every possible user. For example, in the UK, there often are instances where your bathroom is down the hall, not in the unit. That's the case for something on the order of 40 or 50% of the existing stock. That's just a non-starter for many families that are looking for a place for their senior. In Germany, it's double occupancy. So if you come in many instances, if you come in without a partner, without a spouse, you're going to get a roommate, and that could be a great outcome. Or to tell Michael's story, you can't divorce the roommate, unfortunately. So it's just stock that's antiquated. And so we're seeing opportunities to create new stock that is more fitted to the demands currently. We have watched operators try to go to European markets and get it wrong. They've either priced things wrong for the prevailing notions of what's reasonable space, or they've got a buy-in model or something else that doesn't work. So it's really nuanced, but we're seeing real opportunity in Europe at this point, and that's where we've been most active as equity investors in the senior space.
So if you look at this, oh, go ahead, Mike.
Mary mentioned that this concept of a roommate. We actually have a program here in the U.S. where we are doing properties with putting two people at they each have their own bedroom, but essentially as roommates, if you will, in a unit to try and offer something that's a little bit more affordable. I mean, affordable housing in general is an enormous opportunity in the U.S., but the senior space, there's very little of it, as you all know, and this has been pretty well received. We've had good performance in those assets.
I can see it as a really great idea as part of a choice, especially if it lowers costs, but not when it's the only option.
Right. It has to be a choice. And I will say, just talking to our asset managers, there is a little bit of that sort of mean girl thing going on, where you have to be a little fluid to be able to move people to different, you might have to try a couple of roommates before it all works,
Do we really want to probe into what Michael meant by the mean girl thing? Maybe not, Beth. We'll let that one alone.
Well, he has 3 daughters, so he's been around mean girl stuff.
Yeah, absolutely.
So let's talk about that a little bit. So if in the U.S., about 60% of the stock in senior housing is more than 17 years of age. So that wouldn't call that obsolete, but it's definitely moving in an area that, it is aging. And we know since the pandemic that there's been a lot of new ideas of how to keep people safe in terms of isolation areas or in terms of making the dining room accessible at regular times or different times for staff, and fixing the kitchen to be able to serve more in a hotel style when needed. So there's lots of different changes happening. So it's really sort of an exciting time in senior housing because you're seeing a lot of change. And you're seeing, Mary, to your point, a lot of choice too. So there's a diversification and segmentation starting to go on in the industry where you're seeing a lot more opportunities for middle income. It's been a real push from NIC for the last several years to really get out with the message about the huge opportunity from an investor's point of view to invest in middle income housing for seniors, as well as just from a pure society need point of view, because we need to house all these school teachers and firemen, sort of what I call workforce housing for seniors. And then you're also seeing diversification segmentation along rate. So lower price points, sort of traditional senior housing price points, and then you're going into uber ultra luxury properties that are also being built in 24/7 cities. And then you're seeing operators differentiate now along acuity level. So there's a new property type out there, if I can call it a property type, active adult, which is much lower acuity, and it's aimed at a younger baby boomer cohort. And then you see operators that will take people to end of life. So compared to when I first started doing senior housing, we've seen a maturation in the sector, almost like hotels. We have a Motel 6 all the way up to the Ritz, and you're starting to see that in the sector. So it's a pretty interesting time, and I think a lot of good opportunity for debt providers, as well as equity providers, as well as operators. And Mike, I know AEW is doing some of that,
One other dynamic that I've observed that's appealing, as I think senior housing is coming much closer in my life than I would expect. Right, I can shop a property now and feel as though I could really think about it as, would this suit my needs someday? I'm ready for bingo at 10. That's for sure. But what I've loved is that we've also moved away from the senior housing on the hill with the giant swath of grass around it, the separation that's not in a walkable location. That's right for some people, but I love the more urban walk lifestyle element that I would think would suit people that think that that's going to be a component of keeping quality of life longer.
Yeah, Beth, you remember one of our developments in one of our senior housing funds was right in Lodo in Denver, right, and people were very active. Out and about, checking all the restaurants and offering.
Yeah, I just drove by it about 2 weeks ago, Mike, actually.
Oh, okay.
Yeah. Lodo, for those who don't know, is part of Denver, lower near the train station, Union Station. Okay, any other thoughts that either of you have about senior housing that might be helpful for our audience in terms of, the opportunity or the challenges, or something that you guys specifically are doing uniquely towards that?
Well, I have a question which relates to the labor cost side of it. And are we seeing adoption of cost-saving techniques like robotics that we read about? But I'm wondering if it's coming into standard use as a component of operators trying to deal with challenges in getting labor. That's certainly one of the dynamics we look at when we're looking in the UK in light of Brexit. Are we in a position where we could actually get the labor to make the numbers work for the quality of care we're offering? Anyway, is robotics on the list of things that operators are moving toward?
Yeah, for sure. So labor is the biggest challenge right now in the industry. Labor expenses account for about 60% of the overall expense load. And we're seeing average hourly earnings, for example, in the assisted living or the skilled nursing industry exceeding the rates of inflation, which are already quite high. So it's a big challenge. And technology is definitely being offered out there as a partial solution, but it can only go so far. So robotics can maybe deliver the newspaper or deliver the food, but our industry is a care industry, so you really need people to do a lot of it. So you can free up your resources to the best you can to allow people to do what they're hired to do, which is to care for each other. And robotics definitely helps with that, but also just efficiencies that you can gain through technology. And we're also seeing technology play a huge role during the pandemic in terms of telehealth. And all of that frees up staff to some degree to focus on other things that they could be better served at. So, okay, so I'm going to go now to see the questions for the audience. So if you have any questions, just as a reminder, you can go to the lower pane on your Windows and you can see where it says questions. So I have one question here about, I have one comment that as an early investor in senior living, have the returns been as projected? So Mike, that might be suitable for you.
Well, the returns actually far exceeded projections for the first 20, 25 years, largely because of yield compression. I mean, the properties, for the most part, the properties delivered the income that we underwrote. But when we started investing in seniors housing, the average yield on properties was at a very, very wide spread to, as an example, to apartment buildings. And over time, those yields have compressed towards each other. And I don't have the exact attribution, but a large part of the outsized gain certainly was yield compression towards the more broadly invested in, more broadly understood property sector of multifamily. So yeah, the investment returns have been great.
Okay, Mary, one to you. Is there any particular region of the country? We always know real estate is location, location, location. So is there any particular region of the country that you view more favorably, regardless of the real estate type?
In saying what I'm about to say, it fights against the part of me that's thinking about climate change and climate risk. But I would tell you right now, we're focused on places that are seeing strong job growth and strong population growth. That includes Texas and Florida, places that are going to have challenges ahead, right? They're already having challenges with the highest rate of 90-degree days in Texas yet this year, already in May, 90-degree days. But for the moment, they're a draw with people and with corporations, and we are following both of those. That said, we're a Midwestern-based firm, and so we've always been trying to look at more overlooked areas, especially ones like Columbus, that have attributes that can make them stronger relative job growth and population growth locations. Columbus has the University of the Ohio State University. It has all of the intellectual consequences thereof. And it's got a pretty smart economic development policy at the state level. That's the reason that there's a chip plant that's underway there. So we try to find nuance and not just follow the pack, which is running toward the SMILE part of the United States, but we're trying to look as well at instances where maybe the gateway cities are being mispriced because the favor has turned against them for now.
Okay, great. Thank you. Mike, are you or portfolio managers at AEW looking at other ways to drive value, such as operators that use wellness programs to drive improved results? To get improved results could be measured by length of stay, occupancy, or staff turnover.
Yeah, absolutely. Our asset management team has experimented, I guess you will, with different types of wellness enhancement, and not just in seniors housing. We do it in a lot of our residential settings. We were doing it pretty actively in a more affordable category of housing that we call essential housing. At the end of the day, your properties can only really be as healthy, big picture healthy as your tenants are. It doesn't matter what property sector it is. And I think just good asset management is doing anything you can do as a owner and a landlord, anything you can do that improves the life of your tenants is probably to your self-interest as well as theirs. And in places where it's a win-win for everybody, I just think it makes a lot of sense. So yes, we are experimenting with different types of programs across the portfolio to improve different parts of the patient experience, the resident experience, I guess is a better word, helping people to live more full lives. And I think that just makes sense for seniors housing. I think it makes sense for any property sector.
Okay, thank you. Mary, you bringing up like climate change. So how do you underwrite for climate risk? And does that impact your decision on the markets that you decide to focus in on?
Here's how it's being underwritten. First, we look at a range of insurance cost outcomes. We look at a wide range of property tax outcomes because our assumption is the federal government is not going to be in a position to pay for all of the climate mitigation, and that it's going to come either through state taxes or local taxes. And so we use a much broader band of tax assumptions than we did historically. We're also observing that the acquisitions team is getting the numbers, the climate risk numbers run on a prospective acquisition before spending a lot of time on it. And if it's in a high risk area, if it's prone to hurricanes plus sea level rise, plus it's got heat increases and maybe water restrictions, then they may walk away from it without ever engaging the other elements of the team, including my research team. So we're observing them culling out investments before they spend any time in them. And that's an interesting impact. That doesn't mean that we haven't invested in places that have vulnerability to climate change. We're just trying to constrain them as a share of a total investor portfolio to make certain that we're not foolishly overburdening on a risk dimension a portfolio.
Interesting. Yeah, that's certainly a new consideration.
I think one of the biggest challenges that for investing in the U.S. relative to, say, a place like Europe is we have such a huge patchwork of regulations related to climate. Right, New York's got its thing, Boston has its thing, Chicago has a different thing. They're all very, very different. A lot of states don't have anything really. With Europe, with the Paris Accord and all that, regardless of what you think about any of that, at least everybody's playing by one set of rules, right? In the U.S., we're going to end up having at least 50 different regulatory regimes, maybe more, because within states, San Francisco is going to have a different regime than Los Angeles is. I think ultimately cities are going to have their own. So I do think it's a very complicated area for the U.S. and sort of at aggregate puts the U.S. at a bit of a disadvantage relative to some other regions where it's more sort of globally understood what the rules are.
Well, plan sponsors, right there. Yeah. I was just going to say, plan sponsors and pension funds definitely are looking much more carefully at ESG as well as DEI within organizations. So there's a much more social focus on investing than there was 10 years ago.
Yeah.
Mike, you had mentioned, oh, go ahead, Mary.
I was just going to bitch that what I hate about that, all the letters, E, S, and G, each of them so complex, so worthy of focus. And then layering DEI, so worthy of focus into that, it's making these jobs unwieldy, and the reporting element of it really unwieldy. It just makes me want to go and work on getting solar panels on our industrial properties and doing things that actually reduce emissions rather than simply reporting on stuff. But that's just a moment of venting.
Well done. Well said. Mike, you had mentioned essential housing, and I think that AEW is doing a fund now on essential housing. We have a question about what qualifies as essential housing.
Well, essential housing, at least the way we look at it, essential housing is really housing that is affordable to low to moderate income households. People basically making, ballpark 60 to 80, maybe 100% of median area income. It can vary a little bit. A place like San Francisco, you can make well over median and still not find anything that's affordable to you. The U.S. housing market is one of the largest, most liquid asset markets in the whole world, and it largely works pretty efficiently. But there's a serious market failure within the U.S. housing market in terms of providing new supply that is affordable. We don't build much of it in this country, and if anything, institutional capital we all represent, has spent most of the last several decades taking units out of the affordable stock by doing some value-added strategy, going in and redoing the kitchens, raising the rents $300, and euphemistically turning over the tenant base. Well, turning over the tenant base in that segment of the housing market means making a whole bunch of people borderline homeless, because in their micro area, there's probably not another unit that's available that is affordable. The occupancy rates and the stuff run in the high 90s very consistently. And if you have a unit that works for you, yeah.
Is senior housing going to be part of that essential housing fund, Mike?
Senior housing is part of the mandate. We haven't done an essential senior housing property yet, but the fund's very, very new. We just had our first capital raise a few months ago.
Okay, so I'm watching the clock, so we only have a short little bit. So in 30 seconds or less, Mary, is there any other thought you want to share with our audience right now, and something that we haven't talked about that you can briefly touch upon?
I would just say, as somebody whose mother-in-law was in a senior facility during the COVID era, I was so impressed with how the operator tried to make things work well for us and keep her safe, but let her see us. So hats off to you all after a really difficult time.
Thank you. That's well appreciated. And Mike?
Well, I would echo that. My mom passed before the pandemic, but she lived the last several years of her life in a senior housing property where it changed her life. I would say, from a social perspective, from an emotional perspective, this is not a comment on my dad at all, but the last 3 years or so of her life were among the happiest of her life, and I credited a lot of it to the staff and the management of the seniors housing property.
That's great to hear. Thank you. So, in wrapping up, I want to welcome everyone to join us again in 2 weeks on Wednesday, June 8th at 1 p.m. Eastern Time for our next NIC's Leadership Huddle, which is going to be called The Evolution of Market Segmentation. We just sort of touched upon it already today about what we're seeing in terms of active adult, middle market properties, and the ultra luxury retirement communities. So we have 3 specialists who will focus on that, sort of the would-be, those are the no experts. So I hope you can join us then. And then I also invite you to join us for the 2022 NIC Fall Conference, which will take place in September 14th to 16th at the Marriott Marquis in Washington, D.C. Registration for the conference is now open, so register soon to take advantage of the early bird discounted registration rates. And you can learn more about the event at fallconference.nic.org, fallconference.nic.org. And with that, we wish you a good remainder of your day, and thank you for joining us. And Mike and Mary, hats off. Thank you so much for joining us. It was really fun.